Hey there, in my last video, we talked about when is the best time to buy real estate. Well, you get a better deal if you buy now or if you wait for a potential crash. And in order to do so, we looked at what the past has done. We looked at what the market's currently doing, and we looked at the monetary policy changes that are being implemented by the Federal Reserve. And what we were able to do based on looking at all the data is create an educated guess. And that's all I'm able to do. I prefer to call it an educated guess as opposed to a prediction, because a prediction sounds a little bit stronger. And our educated guess, based on all the data and what the Federal Reserve is predicting as to when the economy will recover and when they plan to raise interest rates, we came to the conclusion that we can probably expect 2024 to see interest rates rise, and then we can also expect to see prices go down with interest rates going up. Now, if you want to see more information as to why I thought that or why we came to that educated guess, remember guys, just a guess, not a prediction, go check out that video. But in that video, I also said, if you disagree, if you think that the market will crash sooner, if you think that there will be a bigger crash, prices will go down even more, please let me know down in the comments below, because I would like to refine my answer. I would like to be prepared for that and to know I've looked at the data on both sides and I just haven't been convinced that it's going to happen sooner. And I said, if you do disagree, please leave me some facts though. Leave me some data to look into. Don't just say, you're an idiot, prices are too high, they have to go down. People have been saying that since 2016. That's not going to change my mind. But I saw this video by McCoy Ward this morning, and it pretty much answered my question. Here was someone who disagreed with me and was actually putting together facts and data and graphs to make his case and to make his point. And so in this video, I want to go over the points that he's making as to why he believes the market is going to crash sooner and bigger than what I was making a guess for. And so the first indicator that we're going to look at is that 32% of payments were not made or are outstanding as of August 1st. That's for rent and mortgage payments. That's one of the key indicators that he made in his video, but when I looked a little bit more into it, I found out that 32% number was a bit smaller when it came to mortgage payments. It was only 11% for mortgage payments. Most of those are for rent. Now 11% is still big. I'm not trying to say, hey, 11% is nothing and that we should just turn our eyes to it. All I'm saying is that in his video, it's easy to make it seem like, wow, a third of Americans didn't make their mortgage payment. We're gonna see a foreclosure crisis. It's just a lot smaller when it's 10% of Americans as opposed to a third of all Americans. So still scary, just not as scary as Neil was making it out to be in his video. And then the rest of these that are renters, you also need to keep in mind that most of these renters that are delinquent on their mortgage payments, most renters are renting in apartment buildings and apartment complexes, not your residential single-family real estate. Yes, you're still having delinquencies there as well, but most of your renter number, the 22% that's left over, that's apartment complexes. And yes, commercial real estate is getting hammered hard. I'm not talking about that I don't think commercial real estate will crash in the next 6 months. Yeah, commercial real estate is struggling. I'm talking about residential here, single family or duplexes all the way to fourplexes. Anything past a fourplex, I do think it's going to be very bleak for them. Okay, next point that he made. Oh, also, I wanted to say, I don't know if these outstanding payments include mortgage forbearance. And another thing that I noticed is when I looked at them is that 90% of these outstanding payments were made in full by the end of the month. So essentially, as of August 1st, 32% of renters and homeowners did not make their payments. But by the end of the month, 90% of these 32% did make their payment and they were all caught up. Not to say that that's a good thing, not to say that, hey, the market's healthy and whole, just to say that it's not as bleak as he made it out to be in his video. I think he should have just mentioned these things because it makes you at least realize, hey, maybe the market's not going to crash as soon as he's saying and as big as he's saying. It still probably will crash. I'm not saying it won't. I'm just saying I don't think it's going to happen as soon and as big as he's saying because I don't think he's looking deep enough into these numbers. The next point is debt to income approaching levels of 2007. I thought this was actually pretty interesting. So debt to income generally means, right, if you go to apply for a loan, the bank usually will not lend you any more than 43% DTI, so debt to income ratio. So if it's going to put you, if your mortgage payments are going to put you over 43% debt to your income, you're not going to get a loan. And generally, he was showing in the graph and the data that around 2007, they were at about the average DTI for Americans was around 38%. And in 2018, we were at 36%. They don't have the data for 2019, 2020, what we're at, but he's saying he wouldn't be surprised if we were higher, close to around this number of where we've seen crashes. I think it's an interesting data point. I think it is something that I will keep an eye on going forward. I just don't know if this is so much a causation of a crash, but more of a correlation of a crash. I mean, having a high debt to income ratio isn't what caused the crash in 2008. What caused the crash was bad loans and people taking out risky loans, people not taking out fixed rate loans. So when interest rates went up, all of a sudden their payments went up. I think lending standards are a lot stricter now. I mean, I don't think they are a lot stricter now. You see lending standards and criteria is tightening up, where Chase Bank is requiring you to put 20% down or you're not getting a loan. So they're definitely tightening up, and they're not just giving out loans to dogs and cats anymore. So I don't think this is a causation. I think this is more of a correlation, but still, nonetheless, scary and important to watch. B, debt to GDP ratio is over 100%. So what he's basically saying is that the government is spending more money than we're actually making. Yeah, that's also bad as well. But a thing to keep important thing to keep in mind is that the economy and the markets are not the same. And I think we've seen that, right? The economy is tanking, yet the stock market is high. They do not work in tandem with each other. So in the long run, I agree. I think that's going to have a devastating effect on the real estate market, the stock market. But in the short run, we've seen that they don't work. It's not a causation. They're not the same thing. So point number 2 now, these are all kind of subtopics under number 1. Number 2, the Federal Reserve is buying an exuberant amount of securities. They own 20% of all the mortgage-backed securities. Mortgage-backed securities are basically loans for real estate. So they own 20% of those. In the long run, I do think that this is going to be bleak, right? So they're basically keeping the market liquid so that people can keep getting loans and banks can keep lending. But I don't think it's going to be a problem in the next 6 months and going to cause a crash, because the Federal Reserve just said in their latest press release that they are going to continue buying mortgage-backed securities as necessary. So in the long run, do I think this will be a problem? Yes, huge. But right now, in the next 6-12 months, do you really think the Federal Reserve is going to stop buying mortgage-backed securities? I don't. Point number 3, delinquencies are up 450%, meaning people not making their payments. Yeah, sounds scary, and it is scary, but this number includes people who are in mortgage forbearance. And another thing to keep in mind about people taking mortgage forbearance is that not everyone who's taking mortgage forbearance, and the data shows this, it's not that they all need mortgage forbearance. A lot of them are just taking it as a precaution to save up cash on the side and to not have to make those payments, because in order to get mortgage forbearance, you don't have to prove that you need mortgage forbearance. You just have to say that you're uncertain about your economic future. And that can mean you're still employed, you're just uncertain. Hey, maybe you could get laid off. You don't know. And so you're going to take mortgage forbearance. And I think that's what a lot of homeowners are doing. Now, of course, some of them who are in mortgage forbearance are still taking that and worried and maybe did lose their jobs. But nonetheless, if you're in mortgage forbearance, you can take that for up to 12 months. So that's going to delay, even if these would lead to foreclosures, if these forbearances would, that's going to delay them. So we might not see a crash in the next 6 months like Neil's projecting. And then point number 4, home price to income ratio. What Neil is saying here is that the median home price to income ratio, or median household income, has skyrocketed. So let's say, just to give you a visual example, let's say that the median household income is $80K. I don't know what it is, but we're just gonna go with that. And let's say the median home price was $250,000. He is saying that now what's happened is, let's say you're still making the same amount, right? Income hasn't gone up, people are losing their jobs, but the median home price is now $300,000. So wow, people are taking on even more debt and buying more inflated asset prices when their income is still the same. Here's why I don't think that's necessarily as big as a problem, because interest rates were higher here before all this happened, before the pandemic, before the Fed slashed interest rates. They were higher. So let's say your interest rate is 4% and your payment, we're just gonna make something up here, is $1,500 on this $250,000 house, based on, I don't know, let's say you put 10% down. Now, if interest rates get slashed to 2.8% and you're buying a $300,000 house, guess what? Your payment still might only be $1,500. So you have the same payment. So this person who's making $80,000 a year, it's not costing them any more out of pocket to buy this $300,000 house. And that's why we're seeing prices go up so much, because interest rates are so low and they can afford to pay more for that same price house. So all in all, I liked his video. He has good points. I would encourage you to go and watch the full video to see all the points that he made, to see maybe you disagree with what I'm saying here and you agree with what he's saying. So go check out both of those. If you guys like this video and like this breakdown of how I kind of summed up his video and why I disagree, think about giving it a like, subscribing to the channel if you want to see more videos like this. And if you think anyone would benefit from this information, please share it with them. Thanks.